We all watch company profits, don't we? You know, up, down. That's the big news, right? But to really understand what's going on, especially if you're thinking about shares, your piece of the action, you could say we need to look a little closer. And that's where earnings per share, or EPS, comes in. It sounds pretty basic, profit divided by shares. But the details of actually calculating and showing that number, well, it can get a bit more involved than you might think at first glance.
You're absolutely right, and that's precisely what we're going to delve into today. All those ins and outs of EPS, how it's calculated, how it's presented, all according to International Accounting Standard 33, or IAS 33. Think of it as, well, the global rule book for EPS.
Exactly. So if you've ever seen EPS in a financial report and thought, hold on, what's actually going on here? This is for you. We're going to break it all down, make it clear.
It's like getting a backstage pass to those EPS figures. We'll see what they really mean, why they're presented the way they are.
Perfect. And for this deep dive, we've got a quite a stack of resources to work with. We're looking at the official IAS 33 standard itself, the basis for conclusions, which explains the reasoning behind the rules, the why, you could say. We've got exposure drafts that show us how these rules have evolved over time, and of course, practical application guides, and even some really useful examples. So yeah, if you've ever looked at that EPS figure and thought, there's got to be more to this story, well, you're in the right place. Our mission today, you could say, is to equip you with a really solid understanding of the fundamentals and also to highlight some of those, shall we say, fiddly bits of calculating EPS under IAS 33. Okay, so first things first, basic EPS. Where do we even begin?
Right. So at its heart, basic EPS is, well, pretty straightforward. It's a company's profit or loss, but the part that belongs to its ordinary shareholders. And we divide that by the average number of those ordinary shares that were out there during the reporting period. So in essence, it's like a per-share snapshot of how profitable the company is.
Okay, that makes sense. But that top number, the profit or loss, it's not always just that final number on the income statement, is it? What about if there are other shares or equity instruments involved, like, say, preference shares? How do they fit into the picture when we're figuring out that profit figure for EPS?
Yeah, that's a really important point. With IAS 33, we have to adjust that net profit or loss to factor in any returns that go to those other equity instruments. And preference shares are a prime example. So if those preference shares are classified as equity, meaning they're treated as part of the ownership structure of the company, we need to deduct the after-tax preference dividends from the net profit. Logically, this makes sense because those dividends are essentially a chunk of the profit that's not going to be available to the ordinary shareholders, the ones we're focusing on for EPS.
Right. Okay, that makes sense. So what happens then if those equity classified preference shares get repurchased by the company, before they're due? Or if there are incentives to encourage the holders to convert them into ordinary shares sooner rather than later?
Yeah, those situations can also lead to adjustments in the numerator. So let's say the company pays more than the carrying amount to repurchase those preference shares early. Now, that extra amount, it isn't actually reflected in the profit or loss, but it is a return to those preference shareholders. So it reduces the profit that's available to ordinary shareholders for EPS purposes. Similarly, if the company offers, let's say, a sweetener for early conversion, maybe better terms or some extra compensation, that inducement, well, it's also treated as a return to those preference shareholders. So it needs to be subtracted as well.
Interesting. It's like we're trying to zero in on that profit that really belongs to us as ordinary shareholders in that numerator. Now, there was something in the material about participating equity instruments. Can you explain what those are and how they come into play?
Right. Participating equity instruments and even different classes of ordinary shares that have, let's say, different dividend rights. They add another layer to this whole calculation. The standard says we need to allocate the profit or loss based on how those instruments actually share in the earnings. So it's not always a simple split based on the number of shares. For example, if you have one class of shares that only gets a dividend if the profit goes above a certain level, well, the profit that we're going to use for EPS has to reflect that specific agreement. We look at how the profit would be distributed if all of it were paid out as dividends.
Okay, so reflecting the real economics, you could say, of who gets which slice of the profit pie. And last question on the numerator, what about those big consolidated financial statements we often see? How do non-controlling interests, or NCI, factor into the equation there?
Yes. So with consolidated financial statements, the net profit or loss includes results from both the parent company and its subsidiaries. But for EPS, what we're really interested in is the profit that belongs to the ordinary shareholders of the parent company, right? So if there are any agreements where the parent has to cover losses incurred by non-controlling interests in a subsidiary, those obligations, they also have to be considered in our numerator calculation. Again, it's about isolating the profit that truly belongs to the parent company's ordinary shareholders.
Okay, I see. The numerator not always as straightforward as it seems. Now let's move on to the denominator, that weighted average number of outstanding ordinary shares. I'm guessing that weighted average bit is pretty crucial here.
It really is. The reason we use a weighted average is to take into account the fact that the number of shares that are out there can change throughout the year. The company might issue new shares, it might buy back some of its own shares. The time weighting factor, it basically reflects how much of the year a particular number of shares was actually in the hands of investors. So for instance, if a company issues a bunch of new shares halfway through the year, well, those new shares are only included in the denominator for that second half of the year.
So if we had, let's say, shares outstanding for 90 days out of a 365-day year, they'd get a weighting of 90 divided by 365.
Exactly. IAS 33 says we should weight them based on the number of days they're outstanding as a proportion of the total days in the period. Now, of course, in practice, the standard acknowledges that you can use reasonable approximations, like based on weeks or parts of months, as long as it doesn't make a material difference. You don't need to count every single day.
Okay, good to know. Real-world practicality. What about treasury shares then, those shares a company has bought back and is now holding? Do they still count in the denominator?
Nope. Treasury shares are excluded. They're the company's own shares that it's reacquired, right? And because the cash that was used to buy back those shares, well, it's no longer available for operations, those shares aren't considered outstanding. So they're not included in the denominator, however long the company holds them. It makes sense when you think about EPS as earnings per share held by investors.
Makes total sense. Now, can we look at an example just to really cement this idea of basic EPS? I think you mentioned one from that EPS handbook earlier.
Absolutely. Example 3.1 in that handbook
Mhm.
lays out a really simple scenario. We've got company P, and they have a profit attributable to ordinary shareholders of $4.6 million. Their capital structure is pretty straightforward. 3 million ordinary shares outstanding for the entire year. So to get basic EPS, all we do is divide that 4.6 million profit by those 3 million shares, giving us an EPS of 1.53. Nice and clear.
Yeah, nice and clear. Okay, so that's the basic EPS sorted. But as we know, things aren't always that simple. What happens when there's a possibility of more shares being issued down the line? That's where diluted EPS enters the picture, right? It's like, what if we have to divide that profit pie into even more slices?
Exactly. Diluted EPS takes into account the potential for those earnings per share to be, well, diluted, if you like.
Mhm.
That could happen if certain financial instruments or contracts were converted into ordinary shares or exercised. These are what we call potential ordinary shares.
Potential ordinary shares. So we're talking things like stock options that employees might have, or those convertible bonds that can be swapped for equity.
Precisely. Options, warrants, convertible debt, convertible preference shares, those are all common examples of potential ordinary shares. They're not ordinary shares yet, but they could become ordinary shares in the future. And if that happens, it would bump up the total number of shares outstanding, potentially spreading those earnings over a larger base and thus reducing the EPS for each existing shareholder.
So diluted EPS is like the cautious approach, the what-if scenario, showing us what EPS would look like if all those potential shares actually materialize.
You got it. It's all about providing a more complete picture of the company's profitability on a per-share basis.
Yeah.
We're taking into account all those potential ordinary shares that could water down those earnings, so to speak. The way we calculate it is we start with the same number of shares we use for basic EPS and the denominator, and then we add in the weighted average number of ordinary shares that would be issued if all those dilutive potential ordinary shares were converted or exercised.
Huh.
And typically we assume this happens at the start of the period or on the date they were issued if they came into play during the year.
Okay. So that term dilutive, that's important here. Are all potential ordinary shares considered dilutive? Do we just assume that every single option will be exercised and every bond converted?
No, not at all. We only include potential ordinary shares in the diluted EPS calculation if they would actually decrease the EPS or increase the loss per share if the company's making a loss. This would need to be from continuing operations. Now, if including them would actually increase the EPS, well, then they're considered anti-dilutive, but we just leave them out of the diluted EPS calculation. We're only interested in scenarios that would, potentially drag down that EPS number.
Okay, makes sense. Focusing on the potential downside. You also mentioned a control number in this context. What's that all about?
Right. The control number is basically the benchmark we use to figure out if those potential shares are dilutive or anti-dilutive. Usually the control number is the profit from continuing operations,
Hmm.
the profit from the core ongoing business, you could say, and we use that as our measuring stick. So if a potential ordinary share has the effect of reducing EPS from those continuing operations, then it's dilutive. And even if that same potential share might look anti-dilutive, if we consider the overall profit or loss per share, including any discontinued operations, if it's dilutive to the continuing operations, it's still treated as dilutive for the overall diluted EPS calculation. Continuing operations sort of takes priority in the whole dilution assessment.
Interesting. So it's all about the core business, essentially.
Okay.
Now let's get into the specifics of some of these different types of potential ordinary shares. Options and warrants are pretty common. How do we figure out their impact on EPS? I think there's a treasury share method involved.
Absolutely. The treasury share method is the way IAS 33 tells us to go about calculating the impact of options and warrants. There are a few steps to it. First, we work out how much money the company would get if all those options were exercised. This includes the price the option holders would pay for the shares at the exercise price, and sometimes even the fair value of any future services that employees might still need to provide to actually earn those options. Then, we basically imagine the company taking that cash and using it to buy back its own ordinary shares on the open market at the average market price during the period. The difference between the number of new shares we assumed were issued when the options were exercised and the number the company could buy back with the proceeds, that's what we call the bonus element. And it's that net increase in shares, the bonus element, that we add to the denominator for diluted EPS. So it's not just a simple case of adding the total number of shares the options represent. We need to factor in that potential incoming cash and the company's ability to, in a way, offset some of the dilution by repurchasing its own shares.
Okay, so it's like a measure of the net increase in shares, not just the gross number from those options. What about convertible instruments, like those bonds or preference shares that can be converted? How do they impact diluted EPS?
For convertible instruments, we need to consider the effect on both the numerator and the denominator. So if those instruments are dilutive, meaning that converting them would push the EPS down, we adjust the numerator. We do that by adding back any interest expense, net of tax, that the company would recognize on that convertible debt, or any preference dividends they paid out on those convertible preference shares. The thinking here is that if those instruments had already been converted into ordinary shares, well, those interest payments or dividends wouldn't have happened. Then, on the denominator side, we simply add in the number of ordinary shares that would be issued if those instruments were converted. So you've got the numerator going up because we're reversing an expense or dividend, and the denominator going up because we'd have more shares outstanding.
Got it. What about shares that might be issued in the future, but only if certain conditions are met? Like, say, the company has to hit a certain profit target, or the share price has to reach a certain level. Those are contingently issuable shares, right?
That's right. How we handle contingently issuable shares in diluted EPS all depends on whether those conditions have actually been met by the end of the reporting period. If all the boxes are ticked, then those shares are included in the diluted EPS denominator. But if the conditions haven't been met, well, then we only include the number of shares that would be issuable if the market price at the reporting date stayed the same until the end of that contingency period. It's a bit of a what-if scenario based on the current situation.
Interesting point about using the reporting date price. What if the share price takes a nosedive after the reporting date, but before the financial statements are actually released? Does that change how we calculated diluted EPS?
Nope. Even if the share price drops below that trigger level after the reporting date but before the statements are finalized, we stick with the share price at the reporting date for calculating diluted EPS. The goal is to present a consistent snapshot of the situation as it was at the end of the reporting period.
Okay, consistency is key. Now, what if a company has a bunch of different types of potential ordinary shares out there? Like employee stock options, convertible bonds, and warrants. How do we figure out which ones to include in the diluted EPS calculation?
Right, so when a company has more than one type of potential ordinary share, we have to rank them. We start with the most dilutive and work our way down to the least dilutive. We calculate the impact of each type on the EPS from continuing operations, one by one, and cumulatively. So if adding a particular type makes the EPS go down even further, we keep it in, and we keep going until including the next type of potential shares doesn't make the EPS any lower. So it's a step-by-step process, always focusing on whether we're getting a more and more diluted EPS figure as we add each category.
So it's about like maximizing the potential dilution, you could say. Okay, so we've talked about the calculations themselves, both basic and diluted. But EPS isn't just about the numbers, is it? It's also about how it's presented in the financial statements. What are the key things to know there?
You're absolutely right. Presentation and disclosure are really important to make EPS actually useful for investors. And IAS 33 is very specific on this. Both basic and diluted EPS need to be shown right there in the statement of comprehensive income and with equal prominence. No hiding one away in the footnotes or anything. And if the company chooses to present a profit or loss figure specifically from continuing operations, well, then they also have to show both the basic and diluted EPS figures for just that part of the business.
So, equal prominence and a focus on continuing operations. What about if they have discontinued operations? Maybe they sold off a whole division or something.
Ah, good point. For discontinued operations, the standard says we need to show those basic and diluted EPS amounts. Either we include them directly in the statement of comprehensive income itself or in the notes to the financial statements. This way, investors can see the per-share impact of both the ongoing business and any bits that have been discontinued.
That extra level of detail is definitely helpful for analysis. Now, what about if the company's share structure changes? Say they do a stock split and double the number of shares, or a bonus issue where existing shareholders get extra shares for free. Does that affect the way they report EPS for past periods?
Yes, those sorts of changes, because they change the number of shares out there without actually changing the company's underlying assets or profitability.
Yeah.
They required a bit of a rewind. We have to restate those previously reported EPS figures. So if there's a capitalization issue, a bonus issue, a share split, or even a reverse share split where they combine shares, the company has to go back and recalculate and restate the basic and diluted EPS for all the prior periods that are shown in their financial statements. And they have to do it as if that change had happened right at the start of the very first period they're showing. The same principle applies if there are corrections for past errors or changes in accounting policies that are applied retrospectively. It's all about ensuring that we're comparing like across different periods.
Makes sense. So if a company splits its stock 2-for-1, it's like someone came along and cut every slice of pizza in half. To compare today's pizza slice to what we had before, we need to go back and imagine all those past slices were also cut in half.
Precisely. It's about making those comparisons meaningful. Now, what if these share changes happen after the company's financial year ends, but before the financial statements are actually signed off and published?
Right, that's a good question. What happens then?
Well, in those cases, the per-share calculations for both the current year and any past years shown in the statements they need to be based on the new number of shares. And, importantly, the company has to clearly disclose the fact that those EPS figures have been adjusted to reflect these changes that happened after the year end, but before the statements got the final stamp of approval. Transparency is key.
Okay, transparency is key. Now, I remember reading something about a parent company's separate EPS. Is that something that's commonly reported?
There is an option for a parent company to disclose its separate EPS in some very specific circumstances. But IAS 33 actually prohibits them from showing that separate EPS figure in the consolidated financial statements. And that applies both to the main part of those statements and to the notes. The concern, as they explain in the basis for conclusions, was that having two different EPS numbers, one for just the parent company and one for the whole consolidated group, could be a bit confusing for users of those statements. It could even be misleading. So they decided to really focus on that consolidated performance for the entire economic entity.
Makes sense. Focusing on the big picture for the group. One last question on presentation. What about the year-to-date diluted EPS? Say a company reports its results every quarter or half year. Is that just an average of the diluted EPS numbers from each of those shorter periods?
Actually, it's not a simple average. Calculating the year-to-date diluted EPS is a little more nuanced than that. You can't just take a weighted average of the diluted EPS figures that were worked out for each interim period. And the reason for that is that whether those potential ordinary shares are dilutive or anti-dilutive, well, that's assessed based on the results for the whole year. We use that control number, remember. The profit from continuing operations, that belongs to the parent company for the whole year. A potential share might be dilutive when you look at the full year, but it might have been anti-dilutive in one specific quarter, or vice versa. So the year-to-date number needs to reflect the dilutive impact as assessed over that whole year-to-date period. It's not just the sum of its parts when it comes to diluted EPS.
Right. It's really important to keep that in mind. That nuance really highlights that EPS isn't always a straightforward thing, especially when potential dilution is involved. Okay, so we've covered basic EPS, diluted EPS, and how it's presented. But there are, of course, a few more specific scenarios and complexities that IAS 33 addresses. What about rights issues, for example, where existing shareholders get the right to buy new shares? How do they affect these calculations?
Right, so rights issues are where those existing shareholders are given the chance to buy more shares, often at a price that's lower than the current market price. And this is where the concept of a bonus element comes in. Because they're getting those shares at a discount, you could say. It's like the shareholders are getting a little something extra. To account for this, when we're working out both basic and diluted EPS for all those periods before the rights issue, we have to adjust the number of ordinary shares that were outstanding. And we do that using a factor that's based on what's called the theoretical ex-rights value per share. This way, the EPS figures before and after the rights issue can be properly compared. It's not just about the new shares being issued. We also have to go back and tweak those old share numbers to take that embedded bonus into account.
Okay, so we're sort of retrospectively adjusting those past figures to keep things consistent. We also talked about participating equity instruments a bit earlier. How are those treated specifically in diluted EPS?
So, with participating equity instruments, if they can be converted into ordinary shares, then for diluted EPS, we assume they are converted, as long as that would make the EPS lower. And if they can't be converted into a specific class of ordinary share, well then when we're figuring out diluted EPS, we allocate that undistributed profit or loss for the period to all the potential ordinary shares in those participating instruments, assuming they're all outstanding. And that allocation is based on their respective rights to participate in the earnings. It's another one of those what-if scenarios. We're looking at how those earnings would be shared if all those potential instruments were active and participating.
Okay, so again, it's all about that dilutive effect. Only include them if it lowers the EPS. What about potential ordinary shares of subsidiaries, joint ventures, or associates? You know, those companies that our main company has investment in but doesn't fully own. How do they get considered when we're working out the consolidated diluted EPS?
Right. So with consolidated diluted EPS, we have to consider any potential ordinary shares that have been issued by subsidiaries, joint ventures, or associates. But only if those potential shares could potentially lead to a dilution of the parent company's earnings per share. We make the assumption that those potential shares in the investee company are converted into their underlying ordinary shares. And then we adjust the numerator of the parent company's EPS, the profit that belongs to the parent's ordinary shareholders, to reflect any changes in the parent's profit or loss that would come about from that assumed conversion. This might include, for example, changes in the dividend income the parent receives from the investee, or changes in the share of the investee's earnings that's recognized under the equity method. But importantly, the denominator of the parent's EPS, the number of the parent's own ordinary shares that's not affected by this assumed conversion of the subsidiary. It only impacts the parent's share of the profit.
Right, so it's the parent slice of the pie that's affected, not the number of slices, so to speak. Okay, here's another interesting one. What about those contracts that could be settled in either the company's shares or in cash? How do we handle those in diluted EPS?
Okay, so for contracts like that, where the company has the option to settle in ordinary shares or cash, IAS 33 has a specific assumption for diluted EPS. We presume it'll be settled in ordinary shares, which means we have to factor in the potential dilution from those shares being issued. It's worth pointing out that this is one area where IFRS and US GAAP differ. Under US GAAP, that presumption can be, well, overturned, but only if the company's past practices or a stated policy give us a good reason to believe it'll actually be settled in cash. So with IFRS, we generally lean towards assuming those shares will be issued for dilution purposes, unless there's a strong argument for thinking otherwise.
Right, okay. And finally, what about mandatorily convertible instruments? So those are the ones that have to be converted into shares at some point in the future. How do they get treated when it comes to basic EPS?
The treatment of mandatorily convertible instruments in basic EPS has been a bit of a discussion point, with various proposed amendments over the years. Proposals in a 2008 exposure draft suggested that we should only include them in basic EPS if they also meet the criteria for participating instruments, meaning they participate in the company's profit or loss, just like ordinary shares, based on a predetermined formula. The goal was to ensure that basic EPS only reflects instruments that give the holder a current right to share in the profits, similar to how ordinary shareholders do.
Right, that makes sense. Aligning with the whole definition of basic EPS. Now, last but not least, let's talk about reverse acquisitions. This is where a private company takes over a public company. even though technically, legally, the public company might be the one doing the acquiring on paper. Are there any special things we need to consider for EPS in these situations?
Yes, reverse acquisitions are a unique animal, you could say, with some specific considerations for EPS. So, in the consolidated financial statements of the legal acquirer, which, in a reverse acquisition, is actually the company that was economically acquired, the way they present the equity structure reflects the legal acquirer. But in terms of the actual financial results, aside from that equity structure, those consolidated statements are treated as a continuation of the legal acquiree's financials, which can make things a bit tricky when it comes to EPS, especially for periods before the acquisition happened. The standard says that for those comparative periods, the basic and diluted EPS are calculated using the weighted average number of ordinary shares of the legal acquiree that were out there during that period, and then multiplying that by the exchange ratio set out in the acquisition agreement. This is kind of a blended approach, trying to reflect both the combined history and the current capital structure. It's definitely a more specialized scenario.
Definitely specialized, but good to be aware of. Okay, so we're nearing the end of our deep dive here. Let's just step back and think about why EPS is such a big deal and what some of the ongoing challenges are when it comes to actually applying IAS 33 in the real world.
EPS is definitely a fundamental metric for investors.
Yeah.
It's one of the key ways they gauge a company's profitability. How much profit are they making for each share of stock? And it feeds into other important calculations like the price-earnings ratio. But as we've seen, actually calculating it, especially diluted EPS well, it can get pretty complex when you have lots of different potential shares in the mix.
Absolutely. And thinking back to the basis for conclusions, there were definitely some concerns about potential confusion if companies were allowed to present both their parent-only EPS and the consolidated EPS side by side. So the decision to mainly focus on consolidated EPS seems to be an attempt to prevent that kind of potentially misleading presentation.
Exactly. And there's been a lot of work over the years to make accounting standards more consistent globally. EPS is one area where the IASB and the FASB in the U.S. have collaborated, trying to, iron out some of the differences in how it's calculated and presented. The fact that companies and accounting folks still have questions about how to apply IAS 33, especially when things get really complicated, just highlights the fact that it's not always a simple cut and dried issue. And that's why the IASB has continued to provide more guidance and clarifications.
And I imagine to make EPS a really useful tool for comparing different companies, it's crucial that they all apply these accounting policies consistently, right?
Absolutely. Without that consistency, it becomes really difficult to compare EPS figures across companies, which makes it much harder for investors to make informed decisions.
Okay, so let's wrap up with some key takeaways for our listeners after this deep dive into the world of EPS under IAS 33.
All right. So the main things to remember are that basic EPS gives us that initial per share profit figure, dividing the profit that belongs to the ordinary shareholders by the weighted average number of shares outstanding. And remember that profit attributable part, that can involve some adjustments for things like preference dividends and how different equity instruments participate in the earnings. And the denominator, well, it's not just a head count of shares. That weighted average is vital to account for any changes in the number of shares over that reporting period.
And then we have diluted EPS, which is all about looking ahead and considering those potential future shares. But we only include the ones that would actually bring the EPS number down, those with a dilutive effect. That treasury share method, which helps us figure out the impact of options and warrants, and those specific adjustments we have to make for convertible instruments, those are some key things to remember.
And finally, remember that how EPS is presented in the financial statements is just as important as how it's calculated. Equal prominence for both basic and diluted EPS, those specific rules for continuing and discontinued operations, and the fact that if a company's share structure goes through some major changes, they often have to restate their EPS for previous periods to make sure those comparisons over time are fair and accurate.
Right. And thinking about all those complexities we've talked about today and calculating diluted EPS, it really begs the question, when you're looking at a company's results, how much emphasis should you as an investor really put on that single EPS metric when you're trying to assess their future prospects? And given that there are some judgment calls involved, like figuring out how to handle those contingently issuable shares or determining the average market price for treasury stock, how might those judgments impact how comparable EPS figures actually are across different companies? It's something to bear in mind when you're digging into those reports.
Definitely. And for anyone who wants to become a real EPS guru and explore all those details, we'd highly recommend checking out the full IAS 33 standard, along with the basis for conclusions and any implementation guidance that's been published. There's a whole world of information out there if you want to take your EPS knowledge to the next level.
Well, that brings us to the end of our deep dive into EPS. Until next time, happy exploring.